market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit, and these are your top stories. European natural gas prices soar more than 20% after Iran damaged the world's biggest LNG export plant. President Trump tries to stabilize markets by calling on Iran and Israel to de-escalate attacks on energy assets. And the Fed and the Bank of Japan hold rates with rising concerns over price pressures, while the Bank of England and the ECB are expected to follow suit later today. Of course, we discuss all of these topics this hour with guests including Vincent Mortier, the Amundi Chief Investment Officer. We speak also to Richard Clarida, the former Fed Vice Chair, and Katie Koch, the Chief Executive of TCW. Now, if you look at the markets, stocks in Europe and Asia are slumping after this fresh surge in oil and gas prices seem to be intensifying concerns that the war in the Middle East will stoke inflation and hit growth. Again, the sell-off comes as Brent extended gains from the start of the conflict to around 48%, climbing over $114. You can see currently 115.52. And then, of course, the other big story is not only what we're seeing in LNG prices and gas prices, but Fed officials also continue to expect one rate cut this year, though Chair Jay Powell emphasized that to resume lowering rates, they need to see progress in reducing inflation. So let's begin with Iran damaging the world's most important LNG export plant in Qatar after Israel attacked a giant gas field in Iran. Bloomberg's energy reporter Anthony Di Paola is in Dubai. Anthony, first of all, good morning. What do we know? I mean, do we know how much global energy markets will be affected by these attacks overnight?
Yeah, well, already oil has shot up. I think we were past 113, 115 area, and gas was also rising in Europe. So, it's the fact of hitting some energy assets. We saw that natural gas infrastructure hit in Iran yesterday. The Iranians immediately came out with some threats against specific facilities in the Gulf countries, all of them linked with U.S. Joint venture partners. And we've seen those facilities being hit overnight. One of the biggest ones overnight was the Ras Laffan LNG complex in Qatar. There was some damage there, particularly to Shell's Pearl GTL. That's a gas to liquids plant in Qatar, which sustained considerable damage, and other facilities there as well. And just coming in now, we've seen reports of a drone hitting the Samref refinery that's in Yanbu on Saudi Arabia's Red Sea coast. That's a joint venture plant between Saudi Aramco, the state oil giant, and ExxonMobil. And that hit on Yanbu, which again, as I said, is on the Red Sea, Saudi Arabia's west coast. That's the first time during this war that we've seen a hit on an Aramco facility on the Red Sea. The Red Sea is the key export point for Aramco's crude now, because they are shipping it across country on a pipeline and sending oil out through the port of Yanbu. And those refineries along the Red Sea coast are also pumping out diesel and sending it out to markets like Europe. So it's really a key area for Aramco's continued ability to serve the global market. So this is certainly an escalation in the attacks on energy capacity, Francine.
And so, Anthony, how much are markets now pricing in long-term energy disruption as the war continues?
Yeah, I mean, we'd seen oil hovering around the $100 mark before, so markets were not pricing that in. We've seen that jump today as they react to some of the news. But if we are seeing, and if we are going to see sustained damage on facilities there, it stands that prices could go up even higher. Right now, where we've been is that traders have been watching the Strait of Hormuz, which has been closed to most traffic, cutting off exports out of the Gulf. And they've been watching that for the potential to reopen quickly. And they've been watching the state of the assets in the Gulf. So if energy facilities are not damaged and they can quickly come back into production after the Strait of Hormuz is opened, that would contain prices. But if we're seeing damage and a longer closure of Hormuz, then we're going to see prices keep ticking up, being under pressure as markets lose supply and potentially lose supply for a longer period of time. So that will be a lot of pressure on the market, Francine.
Anthony, thanks so much. Anthony Di Paola, they're a Bloomberg energy reporter, talking us through what happened overnight and the longer-term trajectory for some of these energy markets. So far, the Fed and the BOJ have decided to hold rates. The ECB and the BOE are expected to do the same later today as rising oil prices complicate, of course, their efforts to tame inflation. Well, we're joined by Vincent Mortier. He's Chief Investment Officer of Amundi, and he's with me now. Mr. Mortier, thank you so much for joining us. It feels like the energy complex is upending everything. The markets are still staying quite cool. I mean, they have days of volatility, but how does it change your investment strategy going forward?
Well, I would say the next coming days will be very key to define what will happen next, because so far, until yesterday morning, markets were a little bit logical in a way. I mean, it was an oil price.
Logical or complacent?
It depends on which markets. I mean, a short-dated oil and gas shock. Backwardation, meaning the future prices were pointing to normalization by summer or September. Rates a little bit higher because of inflation expectations, but the curves also flattened because of stagflation possible, so lower economic growth. And equity markets have decided to look through, to say it will be short-lived. Now, since yesterday, and all the news flow which is happening, there is some dots coming. Why? What if it lasts longer? And we have seen some very strange things happening. Gold underperforming, dollar not performing that well, which is strange in a shock. Bonds not a safe haven at all. Equity markets starting to correct slowly from a high point, but so a risk-off environment, but not unfolding the way we were used to. So to navigate is not easy.
Yeah.
I continue to believe that the parties involved will have an interest to find a solution, but the new thing in the equation is that the capabilities which has been destroyed, it will take lots of time to rebuild.
But so what I struggle sometimes to understand with the markets, certainly in this period, is that they thought there would be a quick resolution, and geopolitically there was no quick resolution that we could point to. So what is the market pricing in now? A protracted energy crisis, or still like a medium-term solution that's foundable?
The market has pivoted, I would say, in the last 24 hours, from a resolution within weeks to a resolution within months. And it's not the same thing. I continue to believe that between China will start to feel the pain and will be more and more hungry on the situation, Iran, which will be depleted of financial and weapons, and US, of course, that the political cost will start to become high, and Europe is hit very hard by LNG prices, there will be a convergence of interest to cool down. The issue is that it's not one single party who can decide. It's not the US who can say everything is over. So we need to find a coalition that will solve the issue. There is a Strait of Hormuz, but we see in the last 24 hours that it goes beyond. There are all the production capabilities in various countries.
Yeah. So what does it mean for central banks? Again, and there's a big difference in, what people are expecting from the Fed or what they're expecting from the ECB, but it's still fundamentally the same problem, which is a higher oil price.
Absolutely.
And whether a central bank looks through it or not.
So honestly, I don't. It's one of the toughest jobs around to be a central banker today, because you have two conflicting forces. So you've got indeed headline inflation, which will go up for sure. Core inflation, it remains to be seen, because in Europe we continue to import deflation. So core inflation might not rise that much, and growth will be softer from a low point in Europe. So if I were in the shoes of the Christine Lagarde, I won't hike, because the growth is too fragile, and the inflation spike might be short-lived. So I don't believe ECB will want to break the European growth. Fed is another dynamic, but we believe as well that Fed will continue to cut rates, maybe later, but they will continue. There are many reasons to believe that. And yesterday, actually, the FOMC minutes were opening all kinds of scenarios. So nothing very...
So what happens to dollar, actually, in your scenarios? And we saw, I think, dollar strengthening a little bit. If it weakened more, this could be problematic for the euro.
Yes, so indeed, dollar should have performed better in the sequence, in theory. So it is also showing that there are some underlying forces at play which are pointing to a weakened dollar at trend. So it is a scenario, the dollar is overvalued. And if the Fed cuts and ECB is on hold in the next semester, then US dollar will continue to soften in a context where the US deficit remains outsized. When you got 6 to 7% deficit on public spending, there is no other way out if you want to keep rates under control to soften the currency. So that's why we believe US dollar will continue to go down, and we are positioned for that. Short term, of course, it can strengthen a little bit, but actually, the moves on US dollar has been quite soft. Huh?
So how do you construct your portfolio right now? How much risk do you want in there, and where are your safe havens?
So our big conviction is to max diversify our portfolios. So we believe emerging markets have been hit too much, and there is a long-term value to be captured in Asia at large. India is very cheap today. It used to be expensive. It has become very cheap, very under owned. China as well. Europe, we should not despair for Europe. I mean, there are some interesting situations. And so it's diversification in terms of countries, in terms of size of companies, of sectors. We don't want to put all our bets on US mega caps, for example, and also to diversify in terms of currencies. We believe that it's very important to protect against weakening of the dollar. We have just added some short-dated bonds because we think the market is too extreme in pricing hikes, in particular in Europe. So we bought recently quite a lot of 2-year dated bonds, and I think it will perform a lot. And so
what Europeans, so German, French, Italians, or German specifically?
It's more Germany, Italy, Spain, and France to a certain extent.
Is there anything you buy in the UK or in Japan, or are these idiosyncratic stories?
Japan is an interesting story, actually. We think the Japanese yen is very undervalued. BOG will hike later on. And in the context, we believe to have unhedged Japanese exposures can be an interesting story. And short-term rates can go up. We don't believe JGB, so 10-year or above, can go much higher. So we quite like the 10, 20 years JGB unhedged. I think it can perform quite well. UK is more debatable. We debated a lot. We have a long position on the gilts, which has not performed that well, to be frank. But we have kept it. So we believe BOE will be on hold for quite some time. And in that context, for the carry, gilts are quite interesting.
Okay, one thing that you'd be selling right now that maybe you liked in the last couple. So either something that you think is undervalued or in the markets, or that you'd like to sell.
Yeah, in terms of undervaluation, we have added short-dated bonds, gold. We continue to add gold. The underperformance of gold is a little bit surprising, I would say. Emerging markets at large, equities, LATAM, Asia, local currency bonds, which are very cheap now for some countries. And what we find overvalued is still the tech sector at large. Not all the tech sector, but many players. We think there are still many things that will happen. It will be fast and furious, and the market has not yet repriced everything. And there is a little bit complacency here. There won't be winners everywhere at all. So we have diversified away from the mega tech names in US, but elsewhere as well. So it's this segment of the market where we are a little bit concerned.
Vincent Mortier, thank you so much for joining us. That was, of course, the Chief Investment Officer of Amundi, and we'll have plenty more throughout the day here in Paris. Coming up, we speak to Koch, the Chief Executive of fixed income-focused investment firm TCW. That's coming up next, and this is Bloomberg. This is The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit. Now, turning now to fixed income markets, beyond the geopolitical and inflation uncertainty, the world of private credit has been under scrutiny recently as investors worry that some firms are overexposed to software lending. My next guest argues that credit remains investable, but this is not a buy-everything market. Joining me now is Koch, Chief Executive of the TCW Group. Katie, first of all, I'm so happy to speak to you. So thank you so much for coming here. Look, if you look at credit in general, but actually we've seen a little bit of a difference. The spreads have been widening, right, for both corporates and fixed income. Mm-hmm. Is that a good thing? Is that healthier?
Yeah, I think in general, first of all, spreads haven't widened that much yet in credit. We're hoping more, and the news flow today will probably drive that. Overall at TCW, we're actually underweight credit, both in public and private markets. We came into the year that way, and we're hoping some of this news flow will give us the opportunity to deploy capital in both markets.
I mean, how do you see the news flow actually impacting your world, given all of the uncertainties, but also investors are behaving in different ways depending on which part of the market you're in?
That's right. I was actually thinking about you on the way here, because the last time we saw each other, you might remember this, was at a Billy Idol concert in January.
We feel so cool right now.
Yes, exactly. That was a lot, and that was fun. I was thinking on the way over here, it reminded me of a rock star that's more popular in my house, which is Taylor Swift. And two messages from that is, A, there's a lot going on right now, and B, we all need to calm down a little bit as it relates to private credit. So let me just tell you a little bit of context on us, because I think that will build credibility in what our view is. And then I want to just talk about kind of what is it, what's changed, and where the opportunity is. So in terms of context on us, we've been doing private credit at TCW for 26 years. Actually, 98% of managers started post-global financial crisis, which is a relevant data point we'll come back to. We also don't own any software exposure in our private credit portfolios. We also don't have wealth BDCs in our private credit portfolios. And I'm saying that not to take a victory lap, just to, again, build confidence and credibility that actually we're the beneficiary of things dislocating.
Is that because you saw something in software that you didn't want to touch?
It's such a good question. And no, it's not because we were massive visionaries around what was going to happen in software. It's actually because we maintain a lot of discipline.
Fine.
So we had leverage of 3 to 4 times when the market was at 5 to 6, because we have strong covenants and documentation. So you can either say that we didn't lend to software companies, or you could say they didn't want our expensive capital that was strongly documented. But either way, it led us to not having that exposure. And so I just want to remind people, because I think we're getting a little bit confused in this asset class, kind of what it is, what's changed, and then again where the opportunity is. So this is just bank lending. And bank lending as an asset class is as old as the Notre Dame Cathedral, which we all toured last night. Older, actually. It goes back to Mesopotamia. This is just the way we've financed companies forever. And if you make loans and you approach it as the negative art it is, which is trying to avoid mistakes, so you have contained leverage and good documentation and covenants, you will get your clients' money back. So we think this asset class will persist. It's been around forever, and it will continue. Okay, so what's changed, and where are the problems that people are focused on now? What's changed is actually who's lending the money.
Right.
And post-global financial crisis, as you know well, and as you've reported a lot, the lending's moved from banks to the asset managers. Now, have some of these asset managers lacked discipline? Have they made mistakes that we're now looking at? Yes. And what are some of those things that we should reflect on? Number one, did we allow these funds to become too big? Is a question we should ask ourselves. Number two, when the industry made these funds so big, did it give up discipline? Were covenants eroded? Did documentation get weaker? I do think some of that behavior did happen. And
so you would answer yes to the first two questions?
Yes, definitely. We think there is some misbehavior and some lack of discipline on that part, broadly. And then I would say the portfolio construction point is important, which is that I think the industry started to approach this more as a capital markets exercise of putting loans out versus portfolio construction. So the problem with software is that it became 20 to 30% of some of these portfolios. And this is leveraged finance. Things go wrong. Most of it, a lot of time. And so you just don't want all those things to go wrong in one sector, and then you need the documentation to be able to work out of it. And so there's going to be some reflection on what people could do better. But I want to end by saying this is a massive opportunity. We just published a paper on this, which is available on the TCW website, which is essentially says, as the crowds go for the exit, this is actually the moment where people should be buying. And so we're really excited about new loans and also about rescue opportunities in private credit.
Where do you see those? Because at the same time, if the war rages on in Iran, again, we can debate on what what that means for interest rates and things like that. But you could see, the investors, the famous saying of, you see who swims naked when the tide goes out.
That's right. I would just say, though, and we can talk more about the war and the impact on liquid markets, but in general, that higher level of uncertainty is actually better for prospective returns, so we're going to get better spreads. It's going to be a more lender-friendly environment. You should be able to get better returns at better terms. You also are going to have enterprise value multiples that aren't going up and to the right. That's more healthy from a lending environment perspective. Base rates, because of oil and a lot of other reasons, are probably not going back to zero. Again, that's better for private credit as an asset class. So while yes, there were some mistakes made, and while people's instincts may be to run for the door, at TCW, we think this is an incredible opportunity. And we're sitting on half of our capital base is undeployed. So actually, this dislocation should be a great opportunity for our current clients, and we're encouraging other people to step in now as well.
So, Katie, how do you see it? Are the next 3 months a kind of reckoning time where the ones that were undisciplined will face a lot of concern and scrutiny, and the ones that actually are in a better shape can find opportunities?
This is such an important question, because for most of this asset class's short history, there's been very little manager dispersion. Everybody gets to be a genius when rates are zero and lending money. If you've actually had discipline this entire time, we're going to get very significant manager dispersion. And for us, we're excited about that. We know we feel confident we'll get our money back for our clients because we've been doing it for 26 years. In 26 years, we've had 6 losses. And so this should be a great opportunity for us to differentiate ourselves and for new vintages to deliver great returns.
Where do you see the best opportunities?
Really, at this point, you can get them across all sectors. Okay. We think opportunity set will widen, particularly if the volatility increases. And at the moment, the place we're actually deploying the most capital is in rescue opportunities, where you are in the senior part of the capital structure. You can get a high current coupon. It's the only place where we'll deliberately pick and get some warrants on the equity, and we end up as equity owners in half the situations. And those rescue opportunities should not only outperform the debt market, I think it's also possible, given some of the headwinds facing private equity, that it's a very good risk-adjusted way to actually outperform potentially private equity too.
But you don't see more opportunities. And I don't know whether you look through some of these oil and gas prices, or whether that presents extra opportunities because of everything that's going on there.
First, I would say in general across TCW, and just if I'd said what sectors that we're interested in, both in debt as well as equity markets, one is definitely power transformation in the U.S., and the other would be AI, and we can talk about the puts and takes of that. For credibility, I want to say we launched an AI equity fund a decade ago, so it wasn't like we just started using ChatGPT and said, let's launch a fund. We've been doing it a long time. But those are places where you have this great intersection of high structural demand and historical underinvestment. And so we see tremendous opportunity, regardless of what happens in the macro environment, to invest in both of those spaces.
What do you think will happen in the macro environment?
I mean, I lack the proverbial crystal ball here, but what I would say is that in these moments of dislocation, war in particular, or geopolitics just generally, it tends to create volatility, which is obviously good for active managers, but not necessarily completely change the economic regime. So the question is kind of like, how did we come into this year and how has it changed? Actually, we came into this year already very late cycle, which is relevant across all asset classes. We had a cooling economy, right? A slowing labor market, inflation was under control, and in general, it was late cycle behavior, which led us to be positioned in liquidity, quality, and we're very underweight credit, as I said, versus peers in the benchmark for those reasons. Okay, then it was potentially offset by the fact that we were going to attack affordability, that there was going to be tax relief, and all these stimulative things that the president wanted to do. I'm speaking now about the U.S., just as the world's largest economy, so place to start. And so those risks were in balance. What I would say has happened with the war is that the risks have tilted more negative. And so there is, to us, a stronger possibility that we're going to get we've already obviously had underperformance in equities. It hasn't yet come to credit markets, but we do think that there could be a break in credit markets.
Katie, thank you so much for joining us. Katie Koch there, Chief Executive of the TCW Group. Coming up, the Iran conflict, of course, and the impact on U.S. interest rates. We'll discuss all of this with Richard Clarida, the former Fed Vice Chair and now Global Economic Advisor at Pimco. He's coming up next from Paris, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit, and these are your top stories. European natural gas prices soar. Brent gains 10% after Iran damaged the world's biggest LNG export plant. President Trump tries to stabilize markets by calling on Iran and Israel to de-escalate attacks on energy assets. And the Fed and the Bank of Japan hold rates with rising concerns over price pressures, while the Bank of England and the ECB are expected to follow suit a little bit later. So President Trump has called for de-escalation of attacks on Middle Eastern energy sites after Iranian and Israeli strikes on major gas fields jolted global markets. It comes just days after Trump also warned it would be very bad for the future of NATO if they did not help secure the Strait of Hormuz. Well, joining us now is Benedetta Berti, Secretary General of the NATO Parliamentary Assembly. So thank you so much, Benedetta, for joining us. First of all, do you expect NATO in some shape or form to get involved in securing the Strait of Hormuz?
Well, I would say NATO has not been involved militarily and otherwise in the U.S. And Israeli operations against Iran. But what NATO has done is continue to serve its core purpose, which is to ensure the security and defense of all allies. And in that context, as you know, NATO has successfully intercepted multiple ballistic missiles that Iran launched towards NATO ally Turkey. So that is clearly the priority. That said, the NATO Secretary General has also been very clear that all allies share an interest in having an open Strait of Hormuz, and in that context, there are conversations between different allies on how to best contribute to that goal.
I mean, President Trump again said there would be some kind of consequences if NATO weren't to get involved more, and then he walked back those comments. Do you think there will be, if not retaliation, a consequence for the alliance if they don't get involved?
I think within NATO, the conversation over the last couple of years has been very clear, and that is about European allies doing more and taking a leading role for the deterrence and defense of the European continent in NATO. That is what we're focused on. We're focused on that by meeting the 5% defense spending plan, by enhancing defense capabilities, and of course by making sure that no ally is threatened, for example, by intercepting this reckless Iranian attacks against Turkey.
I also want to talk to you about Ukraine, because there's been, of course, U.S. weapons purchased by Europe and then, for help in Ukraine. Have those been delayed or affected by the war in Iran?
So I would say through NATO, through the Pearl initiative, NATO has been supporting individual allies to purchase life-saving interceptors, including Patriot missile systems, from the United States to Ukraine. And over 75% of those interceptors provided to Ukraine have been purchased through Pearl. So this program is working. Yeah. And I think just very recently, President Zelensky talked to NATO Secretary General Mark Rutte about enhancing what we do in the context of Pearl. So clearly that commitment remains from all NATO allies to support Ukraine.
And you don't see any change going forward, because some of the weaponry that the U.S. were selling to Europe is needed for the U.S. combat in Iran?
I think there's many lessons that we're learning from the war in Ukraine and also from what we're seeing in Iran, and that is the importance to really scale and surge productions. And we do have that issue. We do know we need more interceptors. We also need to find cheaper ways to shoot down drones. So we do know that there is a cost asymmetry that we need to address. I think we are doing that. And of course, when there are multiple threats and challenges, there is a problem of how do you surge production.
How do you do that? Again, so where are the sources where you could diversify or have, anti-missiles and anti-drones that are cheaper?
So there are many things you can do. Firstly, within Europe, we need to continue to invest more in defense so that we send a demand signal to industry that this is not a temporary blip, this is a sustained demand, so they can expand production. And when we do that credibly, it works. Look, for example, on ammunitions. We see that we've been able to incredibly six-fold increase in just a couple of years of production of ammunition. So we need to do that. We need to invest more in sensors. Some of those are commercial. missiles. We can field those relatively cheaply, and those help us to better intercept drones. We can invest in energy laser weapons. There are ways to intercept drones that are cheaper. And then we also need those higher-end capabilities like high-end interceptor, the Patriot system, to ultimately intercept ballistic missiles. But we need to diversify, invest in innovation, and make sure that we address this cost asymmetry.
Benedetta, are European nations and Canada doing enough actually to make sure that Europe is able to defend itself better without the need of the U.S.?
They're doing more, and that's without a question. We still have a long way to go between now and when we get to that 5% for all allies, and between now and when we get to have all the capabilities that we need to have European allies in the lead for the conventional deterrence and defense. But it's happening. We see more forces, more capabilities, gradually also more strategic enablers, but there's no question there's a gap.
I was going to ask you exactly about that. Where are those critical gaps?
There's a few. For example, when it comes to the integrated air and missile defense, we know that Europeans, a year ago, the Secretary General of NATO said we need a 400% increase in European capabilities. Now we need a little bit less because we have purchased, but there's still a long way to go. So there's a shopping list that is pretty detailed. I would put integrated air and missile defense, deep precision strikes capabilities up on the top.
And given everything that's going on, is that list being looked at more intently? Do you think there's there's a bigger will in a way because security around the world has gotten a lot more uncertain?
I would say that's certainly the case. There's more political will, and we see that translated in more defense spending, but there's also more awareness that we need to be more disruptive, more integrated emerging and disruptive technologies. We cannot just keep doing things the old way.
I mean, are we running out of weapons because so much is being used in Iran?
I wouldn't say we're running out, but I see this is a clear signal that we need to seriously invest in our ability to surge and scale at speed, because in the future we're going to have to outproduce and out-innovate any potential adversary.
Okay, Benedetta, thank you so much for joining us. That was Benedetta Berti, Secretary General of the NATO Parliamentary Assembly. Now, coming up, analysts are warning that the current rise in oil and gas prices and destruction of Middle East energy infrastructure will have a long-term effect on inflation. Now, earlier on, I spoke to Philippe Aghion, the 2025 Nobel Prize in Economics co-winner and professor at Collège de France at INSEAD, about what this means for innovation and technology.
I think the Hormuz, to have the blockage of Hormuz is not great, and to have the rise in oil price is not a great thing. I don't think it will lead to disaster. I think what it will lead to is a kind of a slight increase in inflation by maybe 0.4%, whatever, and a slight growth slowdown.
Where do you see Europe on the technological phase?
But the thing is that Europe is stuck in midterm incremental innovation. It's not doing enough breakthrough high-tech innovation. We don't have and why is that? That's the Draghi report, the Letta report. We don't have a true single market for goods and services. We don't have an integrated capital market. We don't have enough long-term funding of research. You know, to do breakthrough innovation, you need to fail. You need to be able to fail. To be able to need risk-taking. And long-term research finance is important if you want researchers to take risk. We need more venture capital to have startups take risk.
Well, that was Philippe Aghion, the 2025 Nobel Prize in Economics co-winner and professor at Collège de France at INSEAD. Let's quickly check on the markets before we go to what we heard from the Federal Reserve yesterday. First of all, so the U.S. Fed, of course, keeping interest rates untouched. It says it won't cut again until inflation resumes cooling. Now, the chair, Jay Powell, emphasized in his press conference that it's too soon to tell what impact a surge in oil prices will have on the U.S. economy.
The thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that you know, to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. It's something quite different than that. We might have much lower than expected pass-through.
Well, I'm delighted to be joined by Richard Clarida, Pimco economic advisor, and of course, former Fed vice chair, who joins us now from Paris. Richard, thank you for joining us.
Yeah, look forward to it.
Do you miss being part of the Fed? I mean, everything's going on. So if you're in charge of the Fed today, do you look through these higher oil prices?
I think that's the first inclination, is to look through. But, you know, we've gone through, Francine, we've gone through 5 years where inflation's been too damn high, and the Fed and other central banks are cognizant of that. And so they're not going to be relaxed, but their initial inclination is to look through.
I mean, how is this conflict and actually this energy crisis different to the past?
Well, what it does is it pushes up prices, which the Fed doesn't like, but it tends to slow activity and push up unemployment, which the Fed doesn't like either. So it's a balancing act. Yeah. Right now, they think the trend in inflation, but for the tariffs and the energy shock, is downward, and they're banking on that, but they're going to keep looking at the data.
So I find it really interesting. Market pricing still has a Fed cuts, but not for the ECB.
Yeah.
So what? I mean, they're dealing with the same problem. So someone has to be wrong.
Well, in part, I think it reflects communication. I mean, the ECB deserves, I think, a lot of credit. They disinflated, got inflation down to target until quite recently. The Fed still has some ways to go, but the Fed's been communicating differently through rhetoric and through the dot and the other projections. I think that's the main difference.
Richard, how do you see this really impacting the U.S. economy? So we talked a little about inflation, but could it actually, you know, we maybe it's a bit too soon, but we're hearing of chief executives thinking about CapEx. I don't know whether this means that people go shopping less, and if it hits the consumer, then we could be in trouble.
Well, I think the longer this goes on, the more significant are the negative consequences. Obviously, the U.S. is an energy exporter, but the U.S. still imports a lot of goods that have an energy content. It'll erode the value of paychecks. Yeah. And so I think a prolonged energy shock, which is not priced in right now, but if it persists, it does slow the economy, notwithstanding the CapEx boom, for example, that we're seeing in AI.
What is priced in? Because in the last couple of days, there was a belief in the market that this crisis would be short-lived. Yeah. But geopolitically, we didn't see any signs of that.
No, I'm not a geopolitical expert, but all the headlines look pretty concerning to me. There is an oil futures market, and the futures price of oil about a year out is around $70 a barrel, not $100. So at least right now, the oil investors seem to think this is going to end pretty quickly. But right now, that's just a guess.
You know, before this, we were talking about private credit, or before the energy crisis, private credit, but also AI and what that meant for software companies. Like, again, how do you see that? We don't talk about it, but underlying, there could be a real shakeout in private credit because of what's happening in the energy crisis.
Well, potentially, and indeed, you know, it's a market that's grown very rapidly from virtually nothing to $2 trillion. It's really not been tested in a downturn, and my Pimco colleagues have made reference to that. We think there are a lot of opportunities in credit, but investors need to be careful and do their homework.
Yeah, where do you see the opportunities?
Well, in particular, the parts of private credit Pimco is really focused on is really asset-backed lending against tangible assets like data centers, for example, or aircraft leases, or other tangible collateralized assets, as opposed to just direct lending into a private equity transaction.
Richard, I mean, also talking about the Fed and, you know, the appointment of Kevin Warsh, there was a legal ruling last week quashing subpoenas issued by the Fed, by the DOJ. Does that delay the appointments or the confirmation of Kevin Warsh?
Potentially, it will depend on, I think, how the administration pursues the appeal. But Francine, what's important to know is that Kevin Warsh cannot become Fed chair until he's confirmed by the Senate. Right. And that confirmation is being held up by Senator Tillis, who said he won't vote on any Fed nominee until this matter is resolved. And so right now, it's a game of chicken, essentially. But we do expect it will get resolved, and that Warsh will eventually end up in the job.
But I mean, could you see, you know, for a while, the chair of the Board of Governors being empty or vacant? And I don't know. I mean, what happens then?
So what Chair Powell said yesterday in his press conference is that he will stay on at least until Warsh arrives. Technically, Jay Powell is two chairs. He's the chair of the Open Market Committee, and he's also the chair of the Board of Governors, and he'll remain in both jobs until Kevin Warsh arrives. And then he also said he hasn't made up his mind whether or not he'll stay on as a Fed governor, which he can do until 2028.
Do you think he will?
I wouldn't expect him to stay until 2028, but he may stay for a while because he really cares about preserving the independence of the Federal Reserve through this transition.
Richard, talk to me a little bit about what you see as the main risk for the Fed right now. And again, I don't know whether it's market pricing that that could be a little bit off or too much volatility.
Well, again, the Fed has missed on its inflation target for 5 years, and so ultimately the Fed's job is price stability. So an important risk is how quickly inflation returns back towards the target. Some of that is out of the Fed's hands, obviously, in particular, the higher oil prices right now. I think a second important risk for the Fed, although I think it will navigate this, is this transition from the Powell Fed to the Warsh Fed, and how Kevin Warsh, who I've known for many years, assumes the role and works with his colleagues. Maybe just to remind your viewers, within the Fed, as established by the statute, the chair only has one vote on interest rates, so we tend to talk about the Powell Fed or the Greenspan Fed, but ultimately the power of the Fed chair is the power of persuasion, and so a risk which I think the Fed will navigate is this transition to Kevin Warsh as the new chair.
So do you think the markets think that, the markets think that this is going to be a dovish Fed? Are they miscalculating that or mispricing it?
Well, I think that the markets believe that the Fed, at minimum under Warsh, will get the federal funds rate, interest rate, down to what the Fed thinks of as a neutral level, around 3%. I think beyond that, the expectation is rates will probably stay there until the next downturn, whenever that is. And then the Fed does have room to cut rates if it needs to.
Have you been surprised by the way dollar's been behaving?
Well, it is one thing we have learned in the last 3 weeks is the dollar has really not lost its role in times of turmoil. There was a lot of talk of sell America a year ago, and the dollar has moved up. So no, we're not surprised. We do think the dollar will continue to be the global reserve currency and reserve asset, and this episode sort of reminds us of that.
Richard, great to speak to you, as always.
Likewise.
Thank you so much for joining us.
Me.
That was Richard Clarida, Pimco economic advisor, and of course, former Fed vice chair. Coming up, we speak to Vanessa Holtz, the Bank of America's France head and Securities Europe chief executive officer. That will also be a good conversation on the markets and, of course, this energy crisis. This is Bloomberg. Discussions here at the Bank of America Global Investor Summit being, of course, dominated by geopolitical risk and the conflict in Iran, coinciding with key central bank rate decisions with the BOE and ECB later today. Now let's discuss what it all means for the banking sector in Europe with Vanessa Holtz, Bank of America France chief executive. Vanessa, as always, thank you so much for joining us. First of all, this dynamic with the Middle East, but also this energy crisis, does it change your outlook on banking in Europe or more on the markets?
So we've seen, obviously, the energy crisis and the conflict in Iran has created quite a lot of volatility in the market. We've seen, obviously, a substantial sector differentiation across equity, and the European banking has suffered. We've seen a lot of stock decreasing on the European banking, and obviously that has a strength. Stagflation is now playing on the cards, so banking sector obviously is impacted by potential raise interest rate. We were in an easing cycle, and now we completely shifted to a potentially hike, in Europe and obviously in UK, and that had an impact obviously on the sectors.
So do you feel like the European banking sector, I mean, it does feel it's much better at withholding anything thrown at it. Do you worry also about private markets and private credit and the impact this could have through secondary effects?
It's definitely a secondary effect we've seen, but there was obviously some concern about the private credits way before obviously the strike, obviously, on Iran. So I think it has to do as well with AI, the leverage that the private credit had, in loan and refinancing, obviously, of AI and software technology. But yes, it exacerbates as well, the private credit. Although, even though we've seen some redemption, I don't think right now it's a systemic crisis, and we are well positioned.
Not systemic, but is there a reckoning coming for private credit?
Yeah, I mean, in a way, when you look at the private credit, it's about contagion and how it will affect the overall industry on that market. So, but it's something that obviously we keep watching. And the market keeps watching. And we've seen, obviously, before that it had a big impact and some kind of systemic impact. We haven't seen that yet, though.
But when you look at market behavior, I don't know whether they're underpricing or overpricing a kind of, the volatility going forward, because there is a bout of volatility, but they're looking for good news. It feels like the market just wants this war to be over almost at any cost, apart from today, where they're starting to realize it could be longer term.
And you've seen that, obviously, just following the weekend when we had, obviously, the Iran. The market was a bit in denial. There was very muted movement in the market. Obviously, afterwards, it got exacerbated. When you look at the TTF market or the older market, you have the volatility massively spiking, but then decreasing as massively, 2 or 3 days later. So it looks like sometimes the market is a bit myopic, looking at the short-term good news, and get used to the good news as well. So that means, and the pricing, definitely pricing, when you look at the oil prices on the future and the long run, they're pricing definitely oil prices below 100. So it is definitely something that is the market is getting used to, and I think probably sometimes a bit too confident.
Yeah, how do you explain that? And also the correlations between asset classes have been, I don't know if they're broken or it's just a new normal.
Well, I wouldn't think it's the new normal, because we've seen some move that we haven't seen for quite some time. And you're right, it's about, the contagion across market. It started with a commodity shock. Then we had, obviously, a rate massive impact. Some big position, that have been put on have been de-risking, degrossing, and winding quite seriously. Huge spike on the front end of the curve. And we've seen as well a lot of impact on the equity market. I mean, some of the equity sectors that have been overbought all 2025 and beginning of 2026 have been the one that have been hit the most, whether it's in Asian market. We've seen a huge sector rotation as well. Yeah. The banking sector that has performed massively has underperformed, obviously, from that front. So you need to be agile in that market. But it's really looking at what our client needs and making sure that we can continue to serve them on any market.
Vanessa, as country head for France, there's a lot of political turmoil in France. I mean, how will that impact not your operations, but how does it impact actually the value that investors give to French equities and French business?
So I think overall we have election in almost a year now, in May 2027. There was definitely some instability in France, and we're looking for more visibility. Investors are definitely looking for that to make sure where they allocate their portfolio. But I think, overall Europe is quite strong. It needs to get its act together. We need to have the single market. We need to have the saving investment union. We need to be able to offer some product to our investor to avoid all this saving that are in Europe that are huge to go away. We need financing at home. And I think that's a critical path for Europe.
Yeah, and it seems, we always say that don't let a good crisis go to waste, and that's certainly true for the European Union, but is this too big a crisis for Europe to forge ahead with some of the banking union and capital markets union that you're talking about?
I think actually the opposite. I think it's when we have, a big crisis, and we've seen that during COVID, where Europe gets it together, the fragmentation doesn't exist. So I think right now we have an urgent call to action. It is now, it's not in 2 years. And I think that's probably the time where they need to do, whether it's on defense, on security, on energy disruption, that Europe needs to act as one.
I mean, will we get a banking union in our lifetime? I feel like I've been asking for the last 15 years.
That's true. We've been talking about the last 14 years, you're right. But I think we're making progress. It's way too slow. You know, we need to be able to operate at scale. We need that pace. We have the roadmap, you know, everything I think is written. It's just the implementation. But again, fragmented, making sure that Europe gets its act together now and not later, because that might be too late to compete.
Vanessa, thank you so much for joining us. That was Vanessa Holtz, the Bank of America France Chief Executive. Now, don't miss our interview a little bit later also with Martin Schlegel, the Swiss National Bank President of the SNB, for the right decision. Now, plenty more to come, of course, from Paris, including Michael Hartnett, the Chief Investment Strategist for Global Research at Bank of America. If you look at markets, look, of course, there's a lot going on. Oil and gas prices are jumping. Again, Iranian missiles have inflicted extensive damage on a Qatari complex housing the world's largest liquefied natural gas plant, and also other facilities in Abu Dhabi, Kuwait, Saudi Arabia. They were also hit. So we look, for example, at Brent, it's above 115. President Trump saying that, look, he's been pressing for de-escalation, certainly in the last 24 hours, asking, for example, Israel to refrain from further strikes on Iran's South Pars gas field. Up next, it's Bloomberg surveillance, and this is Bloomberg.